Hello, friend. A balance sheet is a financial selfie. It shows what a business owns, what it owes, and what's left over. In this video, I'll walk you through 8 real-life examples so you can see exactly how to read them, spot red flags, and fix the most common mistakes bookkeepers make. Now, maybe you're cleaning up some messy books and trying to figure out just how bad things are. Or you're looking at your very first client file and wondering if you did things correctly. Don't worry, we've all been there. These tips will help you double check your work and feel confident before you hand those reports off. All right, let's dive in. The first thing I notice, these accounts don't have account numbers. QuickBooks will still organize them alphabetically, but numbers make it more logical. So with numbers, assets start with 1, liabilities with 2, and equity with 3. So you can see everything in order at a glance. We'll start with the assets section of the balance sheet. The very first thing you want to review is cash. Look at the cash on hand and compare it with your client's records. For example, if you see $150 in cash on hand, take a moment to double check with the owner. Do they actually have this money sitting around in their desk drawer? If there's no cash left at the end of the month, that's fine. But what you should never see is a negative cash balance. Here's the golden rule. Bank accounts, including cash on hand, should never, ever be negative. If you see a negative number here, it's a red flag that something wasn't entered correctly. So, why do negative numbers sometimes show up in QuickBooks? Well, there are a couple of common scenarios. I'm sure there are more. But the first one is insufficient fund fees. A negative bank balance in QuickBooks is literally impossible. Why? Because in real life, banks never let your account go below 0. If you overdraft, the bank covers the shortage and charges you a fee. On your actual bank statement, the account balance will be $0. And then you'll see a separate line for the overdraft or NSF fee, non-sufficient fund fee. So if QuickBooks shows a negative, like our example here, negative $25, it means the fee wasn't recorded properly. Here's another scenario, duplicate payments or withdrawals. Another way QuickBooks can show a negative balance is when the same withdrawal gets recorded twice. For example, you have $500 in checking. You write a $400 rent check. In real life, your balance is now $100, right? But maybe you accidentally enter it in QuickBooks as a bill payment and as a check. So QuickBooks thinks you spent $800 instead of $400. Now it shows checking at negative $300, even though your bank is actually at $100. So why does this happen? The same transaction gets recorded 2 different ways. So QuickBooks Online isn't wrong. It's just doing what you told it to do. But the duplicate makes your balance look negative. To fix this, you'll want to find and delete or void the duplicate entry so your bank account reflects reality. When reviewing accounts receivable, a simple check is to take the total of all invoices added that month, subtract any payments received, and then adjust for last month's balance. This way you can confirm that the current balance is correct. In other words, add any new invoices, subtract payments, and make sure that the resulting balance matches what's on here. Okay, moving on to other current assets. The only account that should normally be negative here is the allowance for doubtful accounts. This is an estimate of invoices you don't expect to collect from customers. Everything else should be positive. For example, I immediately notice inventory showing negative $520.35. Inventory should never be negative. It's an asset. A negative balance could indicate that we've sold more than we purchased, which shouldn't happen, or that there have been incorrect entries with debits and credits. Looking further, I see accessories inventory at $2,415. Look at these two. Inventory negative $520.35, inventory asset $325.75. Even when we combine these two, the overall inventory balance is still negative. So this raises a red flag. At this point, I would investigate. Are these 3 different types of inventory, or should they all be combined into one? Were there any incorrect journal entries or misposted debits or credits? So the goal is either consolidate everything into the correct inventory account or correct the entry so that the balance is accurate. A negative inventory balance is a clear signal that something needs fixing. Next, make sure prepaid expenses make sense for your client, and then we move on to fixed assets. In fixed assets, the only account that should normally be negative is accumulated depreciation, since it's a contra account, and that looks correct here. As I go through the other accounts, I'm checking the names, amounts, and whether they should be positive or negative. Right away, I notice gain or loss on sale. That's an income type account. It belongs on the income statement, not the balance sheet. Ideally, we split it like this. Gain on sale goes under other income and loss on sale goes under other expenses. Seeing it in the fixed assets section tells me there's either a mistake in the account type or a posting error. I'll need to fix it so it appears on the income statement instead. Other than that, everything else in the fixed assets section looks good. Now let's move on to the other assets section. Right away, I notice a negative balance and think, should there be a negative here? In this case, yes. Accumulated amortization should always be negative because, like accumulated depreciation, it's a contra account, so that looks correct. Okay, so from there, I just make sure the other assets are positive, up to date, and properly accounted for, and that wraps up this statement. Now I want to show you a few more examples. Some accounts have numbers, and some don't. For instance, 1330 and 1340 are numbered, but these ones over here don't have any at all. I suggest you fix that. Cash on hand is showing $8,210.55. I highly doubt my client actually has over $8,000 sitting in a drawer at their store, so I immediately know I need to investigate. My first thought is I need to check the checking account and make sure all bank transfers have been recorded correctly. When deposits come through, they usually either match payments received from accounts receivable or be transfers from cash on hand. Think about it. When money is deposited into the bank, my client physically went to the bank with cash or checks. That means the deposit should either be a transfer from cash on hand or a match payment from accounts receivable. Checks usually go through undeposited funds. Cash goes through cash on hand. So if cash on hand is unusually high, it likely means some deposits were recorded directly in the checking account instead of being transferred from cash on hand. I would go back and check those transactions to make sure everything lines up correctly. The one other thing I want to point out here is this loan. A loan belongs in the liabilities section. It should not be showing under assets. Here, the loan was created as a bank account and shows a negative balance. We should never see a negative bank account. Otherwise, the client could be hit with insufficient funds fees. And of course, nobody wants to work with a negative checking account. So two things stood out to me. The negative balance and the fact that it's a loan, which means it should be classified as a liability. This is likely just a case of incorrect debits and credits for the account type. So to fix it, we need to move it to the liabilities section. And that's all I want to point out for this balance sheet. Let's move on. Now for this balance sheet, let's just scan through it like we did before. Cash on hand is 0, which is fine, but as always, you want to double check with your client. Make sure accounts receivable looks accurate as well. The item that really stands out to me here is inventory asset, which is showing just $5.20. That's extremely low. At this point, we need to figure out whether we should combine this inventory with the accessories inventory account or investigate whether the client is actually purchasing more inventory, because $520 is far less than what they should have on hand. Basically, we need to correct this amount so the balance sheet reflects our realistic inventory level. Now, looking at this balance sheet, I notice cash on hand showing $850. That might be correct, but if your client doesn't actually have that cash on hand, we need to investigate. Was a deposit entered when it should have been a transfer from cash on hand or a payment match? Checking that ensures the numbers are accurate. Next, I immediately see a negative balance in other current assets. Normally, the only account that should be negative here is allowance for doubtful accounts. But here we have a negative $8,500 in loan to members. This is a red flag. Remember, loan to members is an asset because it represents money owed to us. Loan from members is a liability because we owe them money. If a loan account is showing as negative, it's probably been posted to the wrong type of account. In this case, a loan from members might be mistakenly classified as an asset. This needs to be corrected by moving it to a liability account. So always investigate unusual negatives. They often indicate misclassified accounts or incorrect debits and credits. Oh, I'm Catherine Silverio, a QuickBooks Pro Advisor. As we approach the end of the year, ask yourself, are your books in order? Are you ready to close out the year and prepare for tax season? If not, I'm here to help. Whether it's cleaning up your books or catching up a few months, I can get you back on track. Text, call, or email me. I'm here to help. By the way, if you want to see how to analyze the income statement, the part of the books that shows your profits, losses, and expenses, I did a full video on that. I'll link it in the description so you can check it out after this video. Now let's move on to liabilities and equity and talk about some things to watch for on the balance sheet. The first thing I notice here is duplicate accounts. For example, we have 2110 accounts payable and accounts payable AP. We only need one accounts payable account, so I would recommend combining them. Similarly, I see Amex credit card listed twice. We need to investigate, is this actually two different cards, or was the same card accidentally set up as two accounts? Identifying duplicates ensures the liabilities section is accurate and avoids confusion when reconciling. When you're looking at other current liabilities, the first thing you want to check is that there are no negative balances. If you see a negative here, that's usually a red flag. It often means something was booked in the wrong place. Maybe a payment or expense got posted directly to a liability account instead of where it really belongs, like an expense or accounts payable. So looking at this example, I see payroll tax and sales tax, which is correct. They're payables. But then I ask myself, where is wages payable? Is it hidden under other liability? If so, we should be more specific with the account name. If it's not listed here, it might have been posted to the income statement. But wages payable is a liability, so it should never appear as a negative expense on the income statement. We don't want negative expenses there. If wages payable is under other liability, the fix is simple. Rename the account to something more specific. This makes it clear for anyone reviewing the balance sheet, especially a tax preparer, who would immediately ask, what is other liability? So clear, specific account names help prevent confusion and ensure the balance sheet accurately reflects what the company owes. Next, let's scroll down and look at long-term liabilities. The only negative balance you should see here is less current portion of long-term debt. So this is a contra account, which means it reduces the long-term liability. So it should always be negative. So why do we have this account? Well, it pairs with current portion of long-term debt, which represents the portion of long-term loans that must be paid within the next 12 months. So together, less current portion of long-term debt and current portion of long-term debt give a clear snapshot of what a business owes this year versus what remains as long-term debt. For example, you might see loans of $10,000 and $9,200, but only $3,500 is due this year. Less current portion of long-term debt subtracts that $3,500 from the long-term total, showing that the remaining debt extends beyond this year. So these two accounts should match perfectly. Adding the current portion back to the net long-term balance should give you the total loan amount. So a couple of key points. Less current portion of long-term debt should always be negative. Long-term loans themselves should never be negative. If they are, it usually means the loan was mistakenly classified as an asset instead of a liability. So this setup helps you and your client quickly see how much debt is due this year versus over the long term. Now let's take a look at the equity section. Here I notice owner's distributions and retained earnings show the exact same amount. That immediately raises a question. Is that truly the retained earnings from last year's profit? Did the business have a small net loss? Or is there a duplicate transaction that really belongs under owner's distributions? Ideally, owner's distributions should be the only negative account here. You might see negatives in net income or retained earnings, but that would indicate the business is operating at a net loss. So other accounts should generally be positive. Owner's equity and owner's contribution should be positive. Opening balance equity should be zero. However, this report shows $1,000. I'll return to this point in a moment. For partner contributions, we want clarity. If there are multiple partners, each should have a separate account. Partner 1 contribution, partner 2 contribution, etc. Right now, a single partner contributions account raises questions. Are all partners equal? How should distributions be split? I would investigate the owner structure and make sure each partner has a clearly defined contribution account. A lot of people don't really know what opening balance equity is or why QuickBooks uses it. Here's the deal. QuickBooks Online is built on double entry accounting. That means every single transaction has to affect at least 2 accounts so that debits and credits stay in balance. So let's take an example. When you create a brand new bank account in QuickBooks and enter a starting balance, QuickBooks has to ask itself, okay, what's the other side of this entry? Because remember, every entry needs 2 sides. If you don't tell QuickBooks where that offset should go, it uses a placeholder account called opening balance equity. That way, the books stay balanced. For example, let's say the owner opens a brand new business checking account with $1,000 of their own money. It's not a transfer from another business account already in QuickBooks. It's not from a loan. It's literally the owner putting their own money into the business. This is what we call an owner's contribution. Now let me show you how this plays out in QuickBooks Online. Click the gear icon, then Chart of Accounts. Hit New Account to create a bank account. Let's call it Bank of America Checking. Account number 1040. And if you enter $1,000 as the starting balance, because that's what the bank account shows, QuickBooks automatically puts it into opening balance equity. And that's why you often see a number sitting in opening balance equity. It's QuickBooks' way of saying, hey, I don't know where else to put this, so I parked it here. So here's the problem. Opening balance equity is meant to be temporary. In reality, balances like this should be reclassified to the proper equity account. In this case, owner's contribution. Leaving money sitting in opening balance equity makes your balance sheet less accurate and can confuse anyone reviewing it, like a tax preparer or auditor. Here's the right way to do it. When creating a new bank account in QuickBooks Online, go to your chart of accounts and create the new bank account. Enter 0 or nothing at all as the starting balance. Record the deposit separately using the owner's contribution account. This way, the actual transaction is recorded correctly and opening balance equity never comes into play. So how do we fix it if the mistake was already made? Let's say the starting balance was entered incorrectly. Let's hit save. And now you see $1,000 sitting in opening balance equity. Here's how to fix it in QuickBooks Online. Go to your reports. Go to the balance sheet. Scroll down. Find opening balance equity and click on the amount. In the transaction list, click deposit. Scroll down and find that deposit. Change the account from opening balance equity to owner's contribution. Click Save and Close. Now, double check your work. Go back to the balance sheet. Opening balance equity should now be 0, which is perfect. And owner's contribution should show $1,000, reflecting the real transaction. Finally, your equity is telling the real story. Keep in mind, this is just one reason a number might be sitting in opening balance equity. Anytime you see a balance there, you need to trace it and make sure it's coded properly. Usually, QuickBooks puts starting balances in opening balance equity when it doesn't know which account to use. Most of the time, these balances actually belong in a proper equity account like owner's contribution or distribution. That's money the owner puts in or takes out. Retained earnings, profits or losses from previous years. Net income, profit or loss for the current year. Partner or shareholder capital accounts for partnerships or corporations. So think of opening balance equity as QuickBooks' parking spot for unknown balances. Your job is to track them down and move them into the right equity account so your books tell the true story of the business. Let's check out this balance sheet. First thing I see, negative credit card balance. That should never happen. It usually means we paid more than we charged, or the account was set up wrong. Maybe it's a debit card. Maybe the debits and credits are flipped. Either way, we need to dig in. Next, I notice there's no wages payable. That's something I'd ask the client about. If the company runs payroll, there should always be accrued wages payable. If it's always cleared by period end, this might be fine. Okay. Our current portion and less current portion match, which is good. Now owner's distributions jumps out. It should be negative. And here it is. It's a positive number. But since the amount matches the credit card, I double check whether something was posted to the wrong account. Everything else looks good. No opening balance equity, and net income can be negative if the business is at a loss, not a red flag unless the income statement tells a different story. Bottom line, investigate that credit card and owner's distribution. The rest, good to go. Let's study another balance sheet. For accounts payable, you double check the balances just like you did for accounts receivable. Add up all the new bills, subtract any payments already made, and make sure the balance is accurate. The credit card shows a positive balance. Good. Wages payable is listed and there are no negatives, which means everything that should be a liability is correctly recorded. The less current portion and the current portion match, so that checks out too. Owner's distributions is negative, which is exactly as it should be. Net income is negative, so either the business is operating at a loss or this reflects accurate reporting. Either way, a negative net income is not great for the health of the business. This is the last balance sheet we're analyzing. My current portion matches my less current portion, and the negative is correct. Oops, there's a 1 cent negative in owner's pay and personal expenses. This is just QuickBooks default account for owner's distributions. If you've imported your own chart of accounts with proper account numbers, you don't want to be using this default account. It's essentially the same as owner's distributions. We need to figure out where that 1 cent came from. Was it a reconciliation difference, a payroll entry, or something else? Once we trace it, we either move it to the correct account or make the necessary adjustment. And that, my friend, wraps up our liabilities and equity troubleshooting. A few quick checks like these go a long way in keeping your books accurate. Oh, I also have a full video on analyzing the income statement, which I'll link in the description so you can watch it after this one. If you found this video helpful, be sure to like and subscribe for more tips on keeping your books accurate and your business running smoothly.